Paul, we're back with the private equity series. How are you doing today?
Good, man. It's good to be back in the office, fighting the tropical storm this week down here in Puerto Rico, but it's good to be back here. And,
That's right.
Looking forward to kicking off session 5 here.
Recording on generator down there.
I literally am recording on generator. As a matter of fact, our entire building and my home is on generator. That's right.
Yeah, that's good. So, we're in part 5 now of our series on private equity. And in this episode, what we want to really focus on is performance optimization and value creation. I mean, essentially, this is one of the core aspects of private equity in that once they make the acquisitions, then it's time to actually, control the operations more so, do more acquisitions, fix up operations, and measure everything along the way while manage it tightly to really create value at the end of the day for a potential exit down the road. So why don't you kick this off for us, Paul, and just kind of potentially, touch on any of those topics that you think is most relevant to start.
Yeah, that's great. I appreciate you setting it up for me like this, Nick. I mean, when I think about private equity in the pest control industry, a lot of times you talk to participants in the industry, they consider selling or otherwise partnering with private equity. They don't spend a lot of time thinking about the fact that when a financial sponsor buys a business, they may use a lot of leverage and they may amortize that over time. But nowadays, they've really got to focus on creating value within that organization to get the return. In next week's segment, we're going to talk about returns, the sorts of returns that private equity investors are focused on in their business. But today, Nick, I wanted to talk about kind of 3 main pillars for value creation within an acquired business by private equity. You've got operational improvement, you've got growth strategies, and then you've got managing and measuring performance within a business. And I think when private equity comes in and makes an acquisition, particularly in a particular industry, they're focused very heavily on these 3 things. And so I thought what we would do today is maybe use Anticimex as an example of how, if you look at Anticimex, it's a private equity-backed business, right? It's owned by EQT out of Stockholm. And they've been in the United States now since 2016. They've gone up and down the coasts. They've made platform acquisitions, and then they've implemented a variety of different strategies and tactics, not only on the operational improvement side, the growth strategy side, as well as the managing and measuring of performance within those organizations. So I think we can do a case study and give some real live examples.
Yeah, that's a great idea. And the one thing I would add is that when private equity, just to provide some historical perspective, when private equity first got going, let's say in the 1980s, even though I know Rollins did, a private equity acquisition in like the 1800s, but I digress. But what's interesting is that back when private equity started, it was largely a valuation exercise and that they bought cheap, fixed the business up a bit, and then sold for a higher multiple. But today, what we're going to cover here is much more important because you don't necessarily have that valuation arbitrage that you used to have. Now it's a operational improvement, a growth strategy, and measuring and managing all these factors as you outlined. So why don't you go ahead and kick it off with this example? I think it's a great one.
You raised actually a really good point. When I think about private equity acquisitions today, I mean, look, they have to pay the same multiples that strategics are paying to buy these businesses, right? And so in order to really get a return, they've got to focus on those 3 things. So I want to start first with operational improvements. When a private equity firm comes in and buys a pest control business, one of the first things that they're doing in due diligence prior to even getting the acquisition done, Nick, is thinking about, okay, how is this business organized? What sort of services does the business offer? What's its pricing strategy? What's its sales and marketing look like? They're basically looking at everything. And part of the exercise of doing due diligence is, number one, making sure that you're not blowing money on a dog, right? Or a fraud, making sure you're not just incinerating cash by making a stupid acquisition. But a very important aspect of due diligence is operational due diligence. And that is, okay, here's our business case. We are buying a $20 million in revenue pest control business that is service charging customers on a quarterly basis, that might be using PestPack but doesn't have a whole lot of a technology backbone within the organization. It is in somewhat of a wider geography, so there might be some route inefficiencies. Private equity firms, the deal teams, are actually sizing this sort of stuff up. And as part of their actual model and their business case, as they determine, okay, what can we pay for this today and what will we likely sell it for in the future, these sorts of things come into play. And so they're spending a lot of time saying, how can we improve the operations of the business? And part of operational improvement ties into all of these three buckets: operational improvement, growth strategies, as well as measuring and managing performance. They're all overlapping, right? So as part of diligence, a private equity firm that's looking at a platform acquisition not only will be looking at areas that they can improve operations, but they'll also be looking at areas where they can measure operations and measure performance where the current business is really not doing that. Now, over the last 5 years, a lot of business owners in the pest control industry have gotten far more sophisticated with measuring and managing performance. But I do think a lot of them have a lot to learn by more sophisticated players that have decades of experience doing this. Finally, when private equity firms are looking at acquisition candidates, one of the biggest things that they'll do is, especially in pest control, it's a route-based service business. And part of operational improvement and growth strategy is also filling in route density, right?
Yep.
It's buying a platform business and then saying, okay, I'm going to buy this $20 million platform business. What is the acquisition pool? What does the universe of potential targets look like in this particular geography? And I've literally sat down with acquirers. I've been out in the middle of the United States in kind of rural area, and you might have a $15 or $20 million pest control business, but there's just a ton of white space around it, and there's not a lot of acquisition candidates. And I've had private equity firms say, hey, it's a great idea. It seems like a great business. At the end of the day, we're not going to be able to do a lot of accretive M&A. And one of the quickest ways to increase not only gross margin, but operating margin is make accretive small add-on acquisitions that make your routes that much denser. So that's why I think in a lot of ways, anyone that's followed the industry for the last 20 years will notice that the extreme majority of the acquisitions have taken place on the eastern seaboard, particularly the Northeast corridor, from basically Boston down into the mid-Atlantic. That is an extremely population-dense area. There's a plethora of potential add-on acquisitions and targets that private equity firms can focus on. So I think today, Nick, we'll delve a little bit deep, perhaps using Anticimex as a case study here, and delve a little bit deeper into each of these pillars.
How about you provide a few examples on the Anticimex situation in how they improved operations after they began to make some of these platform acquisitions?
So typically what a company like AX would do, and I think every acquisition for them is slightly different. And this, of course, is my view as an outsider. This isn't coming from Anticimex, but what I have seen them do. So we've been on the other side of the table from Anticimex on a ton of acquisitions up and down the East Coast. Not only like Modern Pest up in Maine, J.P. McHale in the Northeast. We had Tony Sfredo's business, Triple S, Mike Rogers' business, Killingsworth, the Kramer's business, Innovative, Clark's business, which was a $20+ million business down in South Carolina. The list goes on. But usually what Anticimex will do is they consider, because the United States is so big compared to a European state, for example, they consider, if we use Jim McHale's business as an example, actually, you know what, let's use Killingsworth. Killingsworth is a great example. So Killingsworth, for them, is a country. Killingsworth is based in Charlotte, and it was a $20-some-odd million business. That's like a European country for them from a revenue and size perspective. And so when they came in and they bought Killingsworth, one of the things that they looked at is, in due diligence, they looked and they said, well, Killingsworth does some ancillary services. They were doing lawn care, some HVAC stuff. So they looked at Killingsworth and said, we don't want to do those things. So concurrent with the acquisition, we're going to sell off assets. And that is a pretty common thing for private equity firms to do. If they find a core business they like, they get rid of the non-core stuff. So they made the hard decision up front that Mike Rogers never made, which is like, hey, these are low profit, pain in the ass subs of this business. We're going to get rid of them. Killingsworth is extremely profitable business on the pest control side. And they looked at the pest control business, and Killingsworth was doing annual services. And what I mean by that is they were sending a technician out one time per year to do a very intensive service. And then you wouldn't see that technician for another year. And the customer had the ability to call the company at any time. I mean, it was a warranty all year, but the technician would come out on an annual basis, do an intensive, and then you called if you had a problem. And I remember when Anticimex looked at it, they said, well, the average customer gets 2.1 services per year, but you're only scheduling one. And because half of your services are unscheduled, that creates inefficiencies in a route. So they looked at it and said, well, we're going to do triannual services, because if it's 2.1, it's north of 2. So we might as well just schedule 3 services per year so we can route those very efficiently. And then we're not dealing with a ton of different calls all at the same time. So routing was one area that they really focused on. Another area that they focused on is pricing and billing, right? Like they wanted to put everyone on the subscription billing model. And we see that a lot in pest control in general across the industry. A lot of folks are still charging service charges. So when a private equity firm comes in, they're selling a subscription service. So they're likely to turn to monthly billing, irrespective of what your service frequency is. But Anticimex to that point spent a lot of internal time saying, what is the best service frequency for a pest control company? Is it monthly? Bi-monthly, and I'm talking about on the residential side, but is it monthly? Is it bi-monthly? Is it quarterly? Is it 3 times per year? And they attempted to harmonize that across the organization. And different geographies require different service schedules. Like you would naturally imagine that you'd do less services in Maine than you would at Turner in Florida, but they spend a lot of time focused on that. Another thing that they do, Nick, is they look across their other platform companies and they say, hey, Modern has a great tick and mosquito program. Killingsworth, you're not doing any tick and mosquito. Why aren't you? That's a lost opportunity. So they'll take best practices and they'll cross-sell to the pest control customers. Right? And so what they try to do is they try to focus on services that have the highest margin with the least amount of risk. So they remove things like the non-core services like HVAC, plumbing, and that stuff. They get rid of mold remediation and a lot of things that a lot of the handyman type services that pest control companies tend to do on the side. They get rid of all of that non-core, non-recurring, low margin business, high risk business, because these are higher risk, mold's a higher risk. Handyman services, you're putting people on ladders, fixing houses, using big equipment. They try to de-risk the business by getting rid of those sorts of services and focus on the sticky, high-margin businesses, or high-margin services, I should say. So those, I think, are some very high-level examples of probably just a small handful of a variety of different things that private equity firms do. I can talk, Killingsworth actually had a pretty good IT infrastructure set up, but there's a lot of firms that don't. And so I've seen Anticimex go in and change software. Almost every platform acquisition that Anticimex did in the United States, they ultimately either hired a CFO or changed one. So building out the finance function, because when we start to talk about performance measurement and management, there is a portfolio monitoring aspect of being a portfolio company of a private equity firm. These guys want their numbers on a monthly basis, right? They want to have monthly performance calls. They need to have quarterly meetings. They need board books prepared. And you need a CFO that's got his or her act together to make sure that gets done. So
no, and I mean, the points that you touch on when I think about it from more of a 10,000 foot level is really trying to increase the value of each customer. Okay. So if you're eliminating the complexity associated with these other service lines, whether that be HVAC, whether it be lawn, et cetera, that's obviously increasing your overall margins of the pest control business and the broader operation of each customer. Okay. The route density aspect that you talked about, we all know, the hugely beneficial impact of increasing route density and the impact on profitability. So that's another one. And then, having a CFO within each of these platforms is really a core person that can measure value of each customer, even if you want to call it the net present value of each customer, with which in a consumer-facing business like pest control is really the ultimate metric of value creation. How many customers you have, what's the net present value of each of those customers?
That's right, Nick.
Yeah, the private equity playbook right there is increasing the value through these various operational improvements and structuring of the actual service line and business.
One of the things that I talk about and have talked about on the Buzz a lot is at the end of the day, a lot of folks are searching for tactics. How do I increase customer retention? How do I, what do acquirers look for as attributes for the business? But, when we're talking about value creation at its core, and if we define that, really what is it? It's increasing cash flow and decreasing risk. I mean, you're not buying a business for your health. You're not buying a business because you like to perform pest control services. You're not buying a business for any purpose other than financial return. And so the higher the cash flow is, and the faster that stream of cash flow grows, all else being equal, the more value the business is. And, I think what people always have to consider is that value is inversely proportional to risk, right? The lower the risk of that business, the more valuable it is. And so when private equity firms take a look at the business, they say to themselves, okay, on the risk side, how do we de-risk this business? Well, we get rid of non-recurring services because non-recurring services are more risky than recurring subscription-based services, right? Those customers are stickier. There's more visibility. So they get rid of that sort of stuff. They get rid of all aspects of the business that could potentially impair its value to the best of their ability, and that's those other non-core services. And then as far as growing cash flow, I think one area that we didn't talk about on the operational improvement side is that private equity firms tend to have these ecosystems, and we've talked about these in prior series. And a lot of those ecosystems have digital marketers, traditional online and offline marketers, advertising firms. They have a lot of capabilities that they can bring to bear to increase the performance and lower lead costs to acquire customers. And so that's a key area that they bring to the table. I've seen Anticimex do it. I've seen every private equity firm that ever goes out. As a matter of fact, I was just having a conversation yesterday. I flew here to Puerto Rico and I stopped off and had a conversation with somebody who was telling me, hey, this private equity firm's putting $20 million on the balance sheet at this company, and they are focused now on digital marketing. This is something the company doesn't do very well. So we're going to ramp this up, and this is how they're looking at it. So I think that's a very important aspect of it.
Yeah, you're absolutely right. Like leveraging those capabilities within the broader ecosystem of that private equity firm can increase the value of each individual business within the platform.
That's right.
So how about moving on to one of the other drivers of value, Paul? And we've touched on it a bit, but thinking about growth and how the growth of each individual private equity business can actually be driven within pest control. What are some of your thoughts on the growth drivers?
At its core, because we are in a route-based recurring revenue business that's capital light and has high visibility on future cash flows, and it's a very, very fragmented industry, it's kind of perfect for the traditional roll-up model, and that's what we have seen. And at the end of the day, a roll-up is effectively taking a variety of small independent businesses and otherwise combining them. And so we see that. Like if you look at each of Anticimex's platforms, like JP McHale and Killingsworth and Modern, I mean, each of these companies make a series of acquisitions each year, or at least they have historically. And you might have, a platform like Turner, which was doing 20-some odd million in revenue. And since they acquired Turner, they may have done 15 add-on acquisitions. So again, when private equity firms size up pest control businesses, they're looking at, okay, what core fundamentals are we buying in this platform? And then what sort of opportunity is there to make acquisitions in this particular market? And then they attempt to go and blend down their multiple. Like, so what I mean by that, if I had to pay 15 times for a pest control platform, 15 times EBITDA, and then I might look around and say, well, I want to pay in the single digits. I want to be on a single digit multiple for all the add-on acquisitions that I do. And in my market, there is 250 pest control businesses. Well, I need to start to get smart about the ones that I want to buy. But ultimately, what I'm going to try to do is blend down my entry, as it's called, which is I bought for 15 initially, but over the next 3 years, I'm hoping to pay somewhere between 6 and 10 times for all of my additional add-on acquisitions. And not only will I blend down the cost of my initial entry, but I'm also hoping to get revenue enhancements and cost synergies.
Absolutely.
A revenue enhancement, for example, an example of a revenue enhancement would be, let's say you've got Modern Pest Services in New England. They have a tick and mosquito program. If Modern were to go out and buy a $2 million competitor in that market that does residential pest, and that's all they do, they're a pure pay pest control company. What Modern will do is they'll go out and say, okay, we're buying this business. We're taking this $2 million customer base. In addition to doing pest control, we're going to actually do add-on. We're going to add on tick and mosquito, and maybe only 10% of the customer base will do tick and mosquito. But now I've increased my annual billing by $600 or $700 per customer per year. The ones that have taken that tick and mosquito service. That happens with termite. Like when we did the Altera transaction way back in 2015, Altera was 86, I'm trying to remember, about 80, I can't even remember, 80 some odd $1 million back in November of 15 when that deal closed. And, it's an 80 million in revenue business that was doing no termite at all. Like none. It was pure play pest. And Terminix looked at it and said, well, we've got tens of thousands of customers that we could cross-sell termite services to, or whatever other ancillary service.
Absolutely.
So when you think about growth, you've got revenue enhancements, which is, of course, expanding the services that these customers will buy. You've got the potential to do add-on acquisitions, which do a couple of things. Not only do they give you more route density if you're buying them within the routes, right? You might have $5 million in revenue in one particular area. If you buy a $2 million business, now those customers can be put into these existing routes. You also get some cost synergies or some savings.
I would just say, Paul, even before you go to the cost synergies, the important point for folks to realize is that a lot of value is created because those incremental services that are being added on, the profitability of those is far higher than a customer who is just, using one service. So the incremental profitability or the marginal profitability of that incremental service is massive.
That is an extremely important point. Let's unpack that a little bit.
Okay.
So you've got a pest control customer that you're charging $600 per year and you're doing quarterly services, right? So you're sending a technician out 6 times per year. Let's say that you sell tick and mosquito to that customer. Now, there are some companies that are actually going to have that pest control technician do the tick and mosquito services on 2 of those visits, maybe a spring and a summer visit. Technician's already out there. He takes some bifenthrin. He sprays the place down. That literally takes him 10 minutes, and it might be $200 for that service, right? So that is immensely profitable. And then, tick and mosquito, you're typically coming out every 21 days. So there's additional visits that need to be made to that home. And that's where route density comes into play, right? Because if you've got a lot of density in that area, now you put somebody in that subdivision and they're hitting 20 customers instead of 8. But I do think that the point you raised and emphasized is very, very important. Every additional add-on service is immensely profitable. And so everyone needs to be focused on revenue enhancements. And you don't have to sell to a private equity firm, Nick, to do that, right?
Exactly.
You could be operating your own business today and say, okay, I have 1,000 customers that are buying pest control from me. What else can I sell them? Now, you don't want to go crazy. You don't want to pull a Mike Rogers and say, oh, I'm going to do carpet cleaning and HVAC and lawn services. And, I want to sell them candy bar, whatever. You don't want to do that, but you want to think within reason. And I always say, if you're doing pest control, try to focus on services that are as sticky as pest control and as profitable or more profitable than pest control on a standalone basis.
And recurring.
Absolutely, and recurring. Now, you can still make it work. I mean, it becomes even though another service might be less profitable, you can still make it work, but why would you want to do that? Instead, like focus, like, I do pest control, so let me add on a termite renewal to that. I do pest control, let me add on tick and mosquito to that. I do pest control, I'm not going to add carpet cleaning to that, right?
Right. Absolutely. And before we move on to cost synergies, the other extremely impactful strategic move that private equity typically implements along these lines is pricing increases, right? You touched on it a bit earlier, but we all know that price increases have 100% incremental margin falling to the bottom line. And so after doing a pricing study, I mean, in all of the private equity transactions that you've done, I'm sure you've seen it probably 100% of the time and time again. One of the first things that happens is a price increase.
You couldn't be more correct about that, Nick. I mean, we even do, I'm going to put one up on the screen so that folks can see what a plain vanilla run-of-the-mill pricing analysis looks like. But every one of our clients gets a pricing analysis. And what the pricing analysis tells me is that, let's say that a company has 100 customers, right? Just for argument's sake here. You got 100 customers. What percentage of each of those customers are in a pricing bucket? So, for example, if you have if your company has $90 quarterlies, $100 quarterlies, 110, 120, 130, this is natural. This happens over time. New customers, every year you're raising prices for your new customers, but some of your old customers kind of are sticking around at some of the old pricing. We tend to look at and say, okay, how many of these 100 customers are only paying you $90 per quarter? How many are paying you 100? How many are paying 110? We do that on every deal, every time before we take a business out to market, as we're thinking about it from a valuation perspective. We do that ourselves because I'm really, there is value creation from price increases. And I think there's a fine line, there's a balance. And what I always tell people is that we do this analysis because on the one hand, we can demonstrate to a private equity firm that that demand is relatively inelastic and that there is an ability to raise pricing. But you don't want to raise pricing too much because when you do that, you start to lose customers. So there's kind of a balance there. And I don't want to go way off on a pricing tangent, Nick, but I appreciate you mentioning it.
Yeah. So let's think about cost synergies. So, a company like Anticimex makes their platform acquisitions. The platform acquisition then goes out and makes these smaller acquisitions, which not only blends down the multiple, increases route density, has the opportunity for add-on services and pricing. But since they're operating in these adjacent areas or within the same neighborhoods, you really have an opportunity to just strip out a lot of costs and actually just service those same households with the same team. You have the same office staff, you have the same technicians, which, by the way, now have greater route density, and a litany of other costs that could be taken out while servicing the customers of an acquisition that was added on from the platform. What would you add to that, Paul?
I think that's the concept at its core. And how this works in practice is every time an acquirer looks to do an add-on acquisition, the analysis looks something like this. Nick's Pest Control does $100 per year in revenue. Again, I'm going to use very basic numbers. So Nick, your business does $100 in revenue. You've got 10 technicians, you've got 4 people in the office and yourself. Your business does $20 per year in cash flow. So you're running a 20% EBITDA margin. Now, as an acquirer, I want to take a look at that business and say, in a vacuum, that business is worth, let's call it 8 times that 20. So $160, right? That's what your business is worth.
That's what the business is worth if the Mexican's not involved.
Exactly right. Now, as an acquirer, if I own a platform business, a private equity platform business, I'm looking at that. I'm looking at your target, Nick. I'm looking at your business. I say, well, if I buy Nick's customer base and his business, and I play my cards right, I shouldn't really lose much. And I think nowadays, guys have gotten so sophisticated about how they integrate these things. It's not like it was 15 years ago when Orkin or Terminix would do a deal and 20% of the customers disappeared. I mean, a lot of these deals get done and no customers disappear. Or, there's natural attrition, but there's no exodus. So if I look at it and I say, Nick, you got $100 in revenue, you're only doing pest control. I can sell some termite. I can sell some tick and mosquito because that's what I'm doing already. So maybe I can increase the revenue to 120, right? Maybe. But I'm not going to count on revenue enhancements. I'm just going to look at cost savings now. You've got 4 people in the office. Well, I've got dozens and dozens of people in the office. So in DD, I'm going to take a look at this. I'm going to say, well, you've got 2 people there that want to disappear anyway. I don't even really need to replace them because I've got a call center. Your folks are relatively inefficient, so I can get rid of those 2 people. Now I got 2 people in the office. You've got some technicians. I'm going to be consolidating these routes. I don't need your 10 technicians, Nick. I probably only need 7 of them. Now, I'm not going to fire anyone because I'm growing at 15% a year, so I always need people. But if 1 or 2 of them doesn't want to deal with me or doesn't want to come on board, doesn't matter. And I'll get some efficiencies out of that. As well, I'm able to buy chemicals for substantially less than you are, right? All of my technology solutions are less expensive. I get better financing rates, I get better lease rates. So let's say that I'm able to create 500 basis points in cost synergies just from that sort of stuff. I might take your $100 per year business with a $20 per year margin, and I might now have a $120 a year business within 1 year doing a, I don't know, $50 per year or $60 per year margin. Now, that's my contribution margin. Your business wouldn't necessarily run on its own like that, right? Like I can't remove people and do all that sort of stuff and on a standalone basis have it run. But when I pull it in my business and I get rid of your real estate, I don't need that. I don't need the $5,000 in rent you're paying. I don't need those extra people. I don't need all that sort of stuff. All of that incremental, all that savings flows right to the bottom line. So now instead of a 20% margin business, I might on a combined basis have a 50% margin business that I can bring in. Now, if I paid you 8 times or 160 for that business, and I bought $20 in cash flow, I paid for 20, but I'm really getting 50 or 60. So my multiple is, instead of paying 8 times, my actual multiple is 3 times, right?
Absolutely.
Because I'm buying so much cash flow for the same amount of money. That's the whole add-on acquisition concept. Now, I know we used round numbers and we threw some stuff around, but in concept, that's exactly what these guys are looking to do.
It's a great example, and I think going through that detail is really important. And then to take it one step further, if we think now what they really did is they bought it for 3 times EBITDA after making all of those improvements and taking out the costs as you articulated. Now, when you put that cash flow into the greater enterprise, you effectively paid 3 times, and the greater enterprise might be worth 15, 20 times EBITDA. So there is like a great example of seeing the value creation between buying something effectively for 3 times, but now it's worth 20 times.
So you just raised a great point, because not only did the revenue enhancements and the cost savings change the calculus for you, those on a standalone basis, forget multiple expansion for a second, just those things make it a great acquisition.
Absolutely.
But to your point, there's multiple expansion because this bigger company is valued, each dollar of cash flow is valued much greater than each dollar of cash flow for the smaller, for Nick's Pest Control, which is inefficient and small. My business is much larger. It's private equity backed. I'm going to be able to exit this thing at 15, 16, 17 times. So that whole multiple expansion of literally taking $1 that's worth 3 here and that other dollar, once it's in my business, is worth 15.
Absolutely. It's incredibly powerful.
Yeah. Nick, I want to talk a little bit about performance management for a second. And I think, I'm going to talk a little bit about what I've seen companies like Anticimex do. But I think before I get into that, I'd like to talk a little bit I'd like for you to talk a little bit about private equity firms and what they like to see from a monitoring perspective.
So private equity firms, they certainly have different expectations when you think about how they're analyzing the business, monitoring and measuring the business over time than you see in a 10, 15, or even a 30, $40 million revenue pest control business. Okay. So oftentimes, and you've seen these examples with smaller pest control businesses that, often sometimes executives, they're operating off rules of thumb. And I don't want to necessarily call it feel, but they know their business really well down to the ground. But yet they might not be as precise in measuring some of these return metrics, measuring the financials, on a regular basis relative to a big private equity firm. Okay.
Yep.
So what a private equity firm is going to want to do is have very strict policies and procedures about closing the books every month and actually drilling down on more management accounting metrics to really understand what the underlying economics of the business are and how those are performing relative to their expectations, both expectations prior to acquiring the business, but then ongoing budget expectations that they lay out, each quarter, each month, and each year. Okay. And so what that will typically then entail is detailed management meetings and board level meetings on really trying to understand how that business is performing relative to the metrics that they've laid out with detailed board presentations, decks, or presentations that go through these metrics on a regular basis. So management can be held accountable for the performance, and then continued changes and improvements can be made both on the top line and the bottom line to continue to improve those operations to be consistent with what their expectations are. Is that consistent with what you've seen over time, Paul?
Very, very, very much so. When I think about, the performance management aspect of private equity, a lot of these funds will spend a lot of time with the management team in really trying to understand what are some predictive numbers as opposed to looking at things from an accounting backward-looking perspective. Like, so for example, understanding leading indicators in a business, understanding how, for example, reviews and net promoter score is a front-end leading indicator of retention rates, which you're not going to figure out retention rates until you've actually passed that period in time. Right. Private equity firms spend a lot of time developing playbooks with management teams. I think one of the most interesting conversations I've had on The Buzz, and it was an early episode, Nick, but I interviewed Jarl Dalfor, the former CEO of Anticimex, in his office in Stockholm. And this was like in the heart of COVID. I remember this was September of 2020. It was one of my favorite interviews. And any of you that want to know what it's like to be the CEO of a private backed business, it doesn't matter if it's pest control, lawn care, doesn't matter what industry, what company, Jarl goes into extreme detail and how they boil down operations into a few small numbers. And those are the numbers they relentlessly manage on a day-to-day, week-to-week, month-to-month basis. So I think that would be helpful for any of you who want to get deeper into this. Jarl Dalfor, and I wish I knew the episode number. I do not, but it was early on. It was somewhere around 20 of Boardroom Buzz.
Okay. That's an interesting example. And, other famous notable executives are also known for boiling businesses down to a few metrics. I mean, Charlie Munger, Warren Buffett's old partner who passed away, he's famous for saying, take a simple concept and take it extremely seriously. And when managing a business, oftentimes it comes down to either maximizing or minimizing just a handful of variables. So I think that's a great example.
Yeah.
So Paul, I really appreciate all of the detail that you went into on performance optimization and value creation after being acquired and partnering with private equity, really understanding what the private equity playbook is in continuing to execute on their financial model and going through the operational improvements, the growth enhancements, and really managing and the measurement of those various factors and variables that lead to the value creation, I think was definitely very beneficial. Where are we headed now?
Yeah, Nick, listen, I appreciate you joining me today. I think we're going to close out this series next week, and we're going to focus on returns and commitments, so to speak, in private equity. And what I mean by that is we're going to talk a little bit about what sort of returns on investments that private equity firms are focused on. I think a lot of people ask me in particular, like, hey, if I roll equity, what does that mean? Like, what sort of return will I get? How do I get out of my investment? Like, what happens? Like, can I just call them up and say I'm done and I get paid off? So we'll talk about returns, but we're also going to talk about the commitment aspect of that. Like, if you roll and partner with a private equity firm, what does that mean? What sort of commitments are you making to them, and what sort of commitments are they making to you? So we'll cover that next week.
All right, looking forward to it, Paul.
Sounds good, Nick. See you soon.